Well, just past 12 noon in the East, show you what we're doing here. Decent day going. NASDAQ's the outperformer again, up better than 100 points. That's nearly 1%. There's the Dow, 1/4 of 1%, 0.5 for the S&P, and 357 is the yield on the 10-year note. Jenny, all right, the big wait for the big report. What do we think?
Okay, I think if we come in around 6.6%, that probably makes sense. We've seen each of the last reports decrease, right? It was 8.3, then it was 7.1 at the end of each of the last quarter. So let's say we come in around 6.6%. I think that's what we're expecting. And I don't think that kind of reading triggers a spark that drives the market way up from here. And I think that's because earnings probably aren't going to be great. They may be flat, they may be down, they may grow a little. We already have a reasonably rich multiple. We're trading around 17 times. So what I think a 6.6% reading does for us is actually puts a floor under the market. And so if we come in with numbers that we expect, all that says is, hey, we're probably not going to revisit previous lows. You don't need to worry about going back to October. We're okay.
Interesting perspective, because it mirrors in some ways, Joe, what J.P. Morgan, I mentioned, they game this out every time before the report, and they give you an idea of how much the market can go up or down based on what the actual read is. Remember, November was 7.1, okay? They say a print between 6.4% and 6.6%, which they deem has a 65% chance of happening, produces a decline in volatility across asset classes. S&P goes up 1.5% to 2%. Tech leads the way. By the way, tech has been doing pretty well lately. But that the rally is likely faded, given the move into the number already, right? Markets had a pretty decent move at the beginning part of this year, right?
So what's fresh in my memory is the December report and the significant rally that we had intraday thereafter, and then subsequent to that, the reversal. So if you're trading the futures market and you're focusing on volatility and that's what's important to you, okay, then tomorrow is a signature event. I think the best that you could hope for is that you maintain the positive momentum that has been developed so far year to date, and you're able to carry that into earnings, which begin on Friday. I think that's really the optimistic scenario that you could hope for. If there is an unfortunate inflation number that comes in far worse than feared, then I think you set yourself up on the table for a significant decline.
They agree with you. They say, look out, right?
Right.
But they say if you get above 6.6, that, and they only think there's a 15% chance of that happening, that you get a 2.5% to 3% decline in stocks.
Yeah, I think if there's a significantly worse than feared number, then the market is incredibly vulnerable to that. But beyond that, I don't know if there's going to be enough that's going to come out in tomorrow's report that's going to be able to identify for investors, okay, here's a paradigm shift. This is the report that you focus on. This is why you rush back into risk assets. I think it's nothing more than just maintaining what we've so far established in January.
Rob, so again, you have, expectations that it's going to be another good report. That's why the market's been moving up. The problem is the market's been moving up. You have year to date, Dow's up 2%, S&P 2.5%, NASDAQ 3.5%. Basically, you've had a week or so of trading thus far. Does that cap whatever good feeling there is on the back of a good number?
I think in the short run, if you have a really good number, you could have an explosive move up because of positioning. Positioning is still, decidedly lopsided. So, you get an environment where you get a better than expected number, you get kind of a short-term blow-off. It's really where we get concerned is in the medium term. And in the medium term, you're going to see a cap on these moves just based on valuation. When you start to get some of the really exuberant targets in the S&P, some of which have been talked about on this show.
You mean for the yearly ones, like
for the yearly ones?
Okay, like the 4750s of your guy Tom Lee.
He is my friend, but you would have to see some sort of multiple expansion, right? Or you'd have to see some sort of excess earnings growth. And the way we manage money, it's just not an environment where we're willing to make that bet in the medium term.
On either metric.
On either
multiple
metric.
expansion or surprising earnings growth when people are looking for something not so great.
Yeah. Yeah, I think it's hard because if you look at the numbers, our expectations on earnings are that we're at best flat, maybe decline 10%. If we decline 10%, the market's decidedly expensive. Even today, the market's decidedly expensive. What would necessitate multiples expanding is not a Fed pause. That's not going to drive this. It's going to be a Fed pivot. Let's remember, the last time we saw multiple expansion was in a highly different time when the Fed was
money was flowing and rates were dropping.
Accommodative. In
right?
fact, without that, the highest we got, I think, was like 19.5 times. So you have these two drivers kind of pulling you in. Now, could we middle through? Yes. Do we have to have a recession to see stocks give lackluster performance? The answer is really no, because you can see earnings may be coming in without an economic recession simply because of what's happening in margins right now. Inflation, as much as we hated it, right, it allowed companies to raise price. It allowed revenues to go up.
Right. It's good for earnings.
It's good for earnings. So now we're in kind of an opposite environment of that. And so you really got to pay attention to price. You got to pay attention to quality. And obviously, the noise that's going to happen this year is going to be really loud. So, sometimes you have to ignore it.